Okay. All right. Welcome back to another video. If you don't know who I am, my name is Aiden Hamlin. I turned a portfolio of $5,000 into $25,000 in less than 2 years using very simple but effective methods that I teach young investors for free because it's the right thing to do. There's so much fluff on the internet right now that is convincing you that you can somehow make your $2,000 paycheck turn into this magical $400 a month asset, which it's just not true. That's a 20% return every month compounded. That's 800% a year. If you as an 18-year-old could do that, why aren't the hedge funds doing it too? Just want to put that out there. Now, if you don't believe me, you want to go ahead and try it out, by all means, go ahead and do it. But I think you're a dummy for doing it. I think it is not intelligent of you to do that because you are essentially gambling. Now, how do you invest in the stock market without gambling? How do you just make good investments long term? I'll tell you. Thank you for asking. Now, I want to start this off by just reading you a quick Bible verse that brought me to this realization, and it is Proverbs 13:11, which is, "Wealth gained hastily will dwindle away, but whoever gathers little by little will increase it." I've never seen a company watch 12, I've never seen a CEO watch 12 videos on YouTube about how to run a company, take a $500, $1,000 investment, and then automatically turn it into 100K, 200K, 300K. Doesn't happen. What does happen is that they spend 5 years, 10 years, 20 years even building something that holds intrinsic value that is undeniable. There is so much to deny about trading options, so much to deny about getting a day trading account that you can backtest this all you want. There's no way that you are going to beat the S&P 500 over a 5 to 10 year time frame. As a brand new investor at the very least, day trading. So what do you do instead? Well, if you're 18 to 21 years old and you struggle to understand stocks, do this. To buy stocks, first off, you need a brokerage, and you could use Webull, Fidelity, Public, and many more other options. I prefer Webull for investors because I think it's very user-friendly. They even have a help section that you can find right here, and they essentially break down exactly how you automate your investments so that you can just automatically invest every single month, automatically deposit your money into your bank account every single month without having to constantly go in there manually and constantly update it, constantly put the money in. Now, for most beginners, they don't know what stock to pick, which is where they struggle. They buy Apple, it goes down 15%. They sell it, it goes up 20%. They buy it, it goes down 10%. They sell it, then it goes up to, and they constantly get into these short-term bets on a stock. You're trying to gamble on the performance of a stock, and that's just not how you invest. You invest by holding into a surefire company, a surefire asset with good financials over the course of 5, 10, 20, 30 years. The problem is when you're a brand new investor, especially 18 to 21 years old, you have no idea how the stock market works. You don't know what stock to pick. The best thing that you can do, guaranteed historically, statistically, it is proven the best thing that you can do is invest into something called the S&P 500. The S&P 500 is what they refer to as the market. You don't need to know exactly what it is. All you need to know is that it is the top 500 companies in the US that successfully yield you anywhere from 10 to 15% a year on average. Now, 10 to 15% a year is great because if inflation is 3% a year, you not only protected your money from being worth less, you also made a 7% gain against inflation. Why is that important? So let's use Timmy, little Timmy, as an example. So the S&P 500 averages about 10% a year, so let's go ahead and write this down. 10% a year. Now, 10% a year using something called compound interest gives you 61% in 5 years. So 10% a year compounded is about a 61% return. How I got that number, you could go to nerdwallet.com, type in a 10% yield for your investments, and it's very simple to do. Not going to get too into it right now. All you need to know is that 10% a year over 5 years gets you 61%. Now, what you can then go ahead and do is say, let's say Timmy invests $100 a month from his $1,000 a month paycheck. He is investing 10% of his money every single month for 5 years, meaning that he's invested $100 a month for 60 months. So he has invested a total of $6,000. But that $6,000 isn't worth $6,000. I mean, if you put it in his bank account, yeah, it would be $6,000, but things are more expensive. Eggs used to be $2, now they're $2.50. So now he can't buy as many eggs with the same $6,000 that before he could have bought more eggs with. That is what inflation does. So what investors can do is they put their money into something like VOO, which is an S&P 500 ETF, which is a bunch of stocks in one ticker symbol. Don't try and overcomplicate it. All you need to know is that for every $100 you put in, that $100 is being invested into 500 different companies. Okay? Now, on average, Timmy is going to get a 61% return in 5 years on this $6,000, which means that right now, Timmy invested $6,000 over the course of 5 years, but he has gotten a $9,660 portfolio value, or $3,660 in profit. What's cool about this is that you would say, okay, yeah, but I don't want to invest in something that's risky, and risky with the possibility that it's not going to do well if I'm only going to get $3,000 from it. You're thinking too small. Let's say that Timmy goes ahead, he gets a degree, or he gets a sales job, or he becomes an electrician, or he does whatever, and now he's not making $1,000 a month, he's making $5,000 a month. If he were to invest $500 a month into these exact same assets, right? Let's say $500 a month, or let's just use an extreme example, $1,000 a month. If Timmy invested $1,000 every single month and he gets a 61% gain on those $1,000 a month at the end of 5 years, he has invested $1,000 for 60 months, which is $60,000. $60K. What happens is that Timmy, because he invested like a smart guy, instead of holding money in his bank account, instead of having 60K, he has 96.6 grand. That's pretty interesting. To me, that is way better than letting the wind go ahead and take my money. That down payment I wanted to put on that house is more expensive. My medical bills are more expensive. My rent is more expensive. My food is more expensive. No, now I have a nice little nest egg. I made an extra $36,000. Doing what? Nothing. All I did was invest into a surefire asset for 5 years. But you might be thinking, okay, well, Aiden, what even is the likelihood that I can get to 96.6K? That is such a great question. I'm so glad you asked. The likelihood that you get a positive return in 5 years is 89%. Not 8.9, not 829, 89%. Meaning only 11% of the time over the course of 5 years could you expect to underperform holding cash. That's an insane statistic. And what's really crazy, let's say you do this for 10 years, your likelihood of success over 10 years is 95%. 95% of the time you invest into the S&P 500 for 10 years, you will be better off than had you just put your money into a bank account. That is the power of compound investing. That is the power of the S&P 500, and that is the power of stocks and the stock market. Obviously, you're probably not going to be able to invest $1,000 a month. That is not your goal, right away at least. Your goal